Well, welcome back, ladies and gentlemen, to capital budgeting and project risk analysis. As we consider all the prior sections of this particular course, everything really has been kind of leading up to this particular section because it's going to incorporate both the time value money, risk and return, weighted average cost of capital, debt and equity financing, all kind of sums up into what we're really talking about here within this particular section. I would argue that this is probably the most important section of the entire course, just from the perspective that, at least from my experience, I use this probably more from an operational standpoint, probably more than anything else of all the content that we've discussed up to this point. So what are we really talking about? Well, capital budgeting is just the analysis of potential additions to a business's fixed assets. We can talk about assets from a very broad perspective here, new projects, new initiatives, new service lines, whatever the case may be. Of course, the stereotypical use of this is I'm evaluating 2 or 3 vendors to be able to buy a new large piece of equipment. Well, what does that really mean? What's that really return to us? All that sort of thing. So as such, these decisions are typically long-term, very large expenditure, and have some sort of strategic implication or direction. And obviously, the kind of almost goes without saying it's important to what we're doing. So really we're talking, anything that I just discussed: mandatory replacement, expanding new services, new service lines, whatever the case may be. And what I would argue as we start to look at pro forma analysis, or any sort of projectionary basis, I frankly use the capital budgeting process and capital budgeting framework to help us do that. So from an investor-owned standpoint, those projects, that we're incurring, we're really trying to figure out whether the project actually contributes to shareholder wealth. Not-for-profit businesses or organizations certainly have the same or similar sort of implications, because again, we want to understand what the cash flows are in terms of an expense side, but also what it's going to do for the organization, for the community, and that sort of thing. Okay, now I will argue that capital budgeting, the actual framework, the actual math involved, is relatively easy. In fact, it's very straightforward. It's not unlike what we've done in the very first section of the course with regards to use of net present value and internal rate of return. The difficult part about capital budgeting is understanding what all of the operating cash flows or any sort of terminal flows or any sort of risk factors involved in the particular project are going to be. So while the math is easy, the structure is easy to develop. Understanding, being able to research, use and gather the data, bring in proxy information, ground yourself in literature so that you have some sort of logical basis of why you are actually doing what you're doing, and entering data into these spreadsheets is the incredibly difficult parts of this. Okay, and I would argue this is actually what separates the really good leader in any industry, being able to truly understand and articulate what the nuances are, and how those nuances might manifest out into cash flows within this particular project or this particular investment or initiative. Really is the what separates the good leaders from the not so good. Okay, so this is a great skill to onboard. So with this in mind, a lot of things, a lot of factors to consider. Okay, we have to be able to identify the relevant cash flows. I just discussed that. We have to understand the difference between real cash flow and some sort of contrived accounting income. And the most notable one we talk about in capital budgeting with regards to accounting is how we handle depreciation. Okay, and we'll talk through that in just a little bit. We have to understand the project life, how long of a time period and when those cash flows occur. We have to understand sunk and opportunity costs. Sunk costs are anything that happened before this project we do not want to include in the project itself. But we do want to consider and perhaps include opportunity costs if we're foregoing other income by virtue of doing or pursuing this particular project. We have to understand the ripple effects across our organization. If, for example, in a hospital setting, I'm making changes to the emergency department, right? Changes in the emergency department are going to have influence and ripple effects across the entire organization, because that's the primary conduit through which patients enter our organization. Okay, so we have to understand the impact on the laboratory, the pharmacy, radiology, up into the nursing wards, effects on all of our administrative staff as well. Likewise, we want to consider and understand cannibalization. By doing X, are we stealing revenue profitability from Y? Okay, and are there, how far out do those ripple effects occur? We want to understand shipping and installation costs, any sort of site prep costs. We want to understand, in how this particular project or initiative is being financed. Even though we're going to use the weighted average cost of capital, we do want to understand the impact on cash flow, especially from a working capital standpoint. Is it going to impact, or especially negatively impact, our working capital? That may, of course, influence any short-term capital needs, our ability to pay employees, keep the lights on, and such. Okay, we want to understand inflation. We want to also be careful of any sort of cash flow estimation bias. And bias I put in red because it is a four-letter word. Okay, if you are on the leadership side of things, evaluating a capital budgeting project, you need to be very, very careful about who brings you what data, and who and what has a dog in the fight, so to speak. As these projects get large, as people have vested interest in seeing something develop or pursued, you want to be very careful about overestimating cash flows. Okay, so with that, my argument or my suggestion from a professional standpoint is you need to make sure that all of your data, especially as it pertains to volumes, pricing, demand schedules, whatever the case may be, all that data needs to be very well referenced. Secondarily, needs to be fully disclosed within your presentation or materials that you provide to any decision makers in the organization. Okay, vitally important, because one, you don't want to be perceived as biased, because once you are, then there is the concern from that point forward that you are going to somehow taint the results, okay, or put your finger on the scale. You want to be as transparent as possible, and that's why I'm hitting it so hard. And of course, we want to understand any sort of strategic value that we might have. So, just as an example, put together a very short scenario involving a clinic evaluating a new piece of diagnostic equipment. Has a purchase price of $200,000. There are shipping and installation costs involved of about $40,000. We're going to deal. This is a not-for-profit organization, so that implies that we're going to set aside taxes for a short period of time, or for the duration of this project at least. Expected life of 4 years, salvage value of $140,000. We've got utilization there, or volume of 5,000 scans per year. We have a revenue structure of $80 per scan. Supplies cost is $40,000. We have labor costs of $100,000, an inflation rate of 5%, and weighted average cost of capital of 10%. So, like all projects, we want to start out with our timeline, operating cash flows with an initial cash outflow and a terminal value cash flow over there in year number 4. And down at the bottom, of course, we have net cash flows from 0 out to 4. So now that we have the structure developed and we kind of have this starting data, we can start to populate that kind of skeletal structure and figure out exactly which way the rabbits are running with regards to cash flows. So at time period 0, of course, we have our equipment cost as well as installation and shipping of $40,000, so a total outlay of $240,000. From an operating cash flow standpoint, we have our revenues, which again, if you go back here to the number of scans per year at $80 per scan, over here on the left-hand side, 5,000 times 80, that reaches or allows us to start at $400,000. Supply costs, I believe, were $40 per scan at 5,000 per year, so that's our $200,000 threshold. Labor costs of $100,000. For a net operating cash flow in time period 1 of $100,000. Okay, and then from here, this is our baseline. Now we're inflating these numbers just based on the inflation rate of 5%. Now we're just taking a salami slice inflation rate across all sections here. Of course, as your projects become more nuanced, your projects you get more granular in terms of your understanding of what's going on, you can adjust based on what you know of the local market, and basically your own contributory factors to what's going into each one of these. Okay. At the back end of the project, we have a terminal cash flow at time period 4 of $140,000. Because this is a not-for-profit organization, there is no tax on the salvage value. But as we'll see at the back end of this presentation, we have an example where we will apply tax, and it becomes a fairly significant area of concern with regards to actual accurate valuation. But we'll just set that aside for now. So as you're actually doing this, I suggest that you open up Excel and follow this along. Enter your timeline, your data. Again, this is all based on our operational cash flows. So of course, here's our $100,000 over here. This gets put into our timeline. Our $240,000 is our initial investment, so on and so forth. And of course, these are all estimates, but these provide our baseline. It starts to provide some sort of basis for us to understand exactly what this project is going to do. So first and foremost, kind of to revisit what we talked about early on in the course with regards to return on investment, net present value, internal rate of return. Okay. I would argue again that any sort of break-even analysis that you're going to use, any sort of evaluation analysis that you're going to use, really needs to be using time value money techniques. Because as you can understand, if we go back up, based on what we learned early on in the course, this $110,000 out here in year 3 is at a much different valuation based on our discount rate than this 100, even if this was $110,000 here in year 1. So we have to be careful about any sort of non-time value money valuation techniques, but we should be able to also determine an adjusted dollar return as well as a percentage return on this project. Okay, so in this case, we're going to apply our weighted average cost of capital that we learned about in the last section of 10%, and we adjust for risk by adjusting that discount rate. So based on some organizations that I've worked with in the local market, in at least within the healthcare setting, we have organizations that apply a different discount rate to all capital projects, right? Each one has their own valuation technique in terms of how they arrive at that, and in some cases it's just a flat, a flat rate to accommodate for all sources of risk. But in this particular example, we're going to stick with our 10% weighted average cost of capital just to see where things start out. So again, this is what the valuation process looks like. Brings it back to a starting net present value of $195,000 and change. Okay, so if we were to take this from a mathematical standpoint, of course we can do this mathematically. Net present value is just our cash flows. Each year is divided by, in this case, our discount rate, okay, and then raised to an exponent in each case out to, in our particular example, this would be out to year 4, and then we subtract out our initial capital outlay. That's the ICO that we see there. And of course we can do that mathematically like I just explained. But fortunately, as we learned in the early part of the course, we can use the net present value process, put in our net present value. Here's our 10%. Here are all of our values in the example. And of course, we could key them in individually, or we could just, on an Excel spreadsheet, just highlight one, drag it over to the last one, and then close our parentheses. And we end up with a cell display, though, of $435,000.18. But as we learned early on, this is only including years 1, 2, 3, and 4. We then have to go back and add in our time period 0 to arrive at our final net present value of 195.18, which is what we found up here just by doing things longhand. Okay, so what this means, of course, and we again, to reiterate the point we made early on in the time value money section, this is the dollar contribution of this particular project to the equity value of the business. Okay, anything that's positive signifies the project will enhance it. and the higher that the net present value is, the more attractive the project is financially. This also provides us a means to be able, from a dollar valuation standpoint, to understand as we start to compare project against project against project, which one of these projects is going to yield us the most basically dollar return for the amount of capital that we put into it. Okay. So, and what's the meaning of a net present value of 0? That's essentially our break-even point for this particular project, and would be kind of the demarcation point from a quantitative standpoint of whether the project was viable or not. Okay, but of course we also want to be able to measure our returns from a percentage standpoint. And again, to reiterate, this is the discount rate that forces our present value of inflows to equal the cost of the project outflows. Or basically this is the discount rate that forces the NPV to equal 0 exactly. So with this in mind, we do the same sort of valuation that we learned in the time value of money process. And again, we can do this mathematically if we really wanted to. This is the formula that we would follow to do that. But using the spreadsheet formula, we can actually do all that work in a very short amount of time. And again, equal IRR, open our parentheses, drag across the entire series of cash flows this time, close our parentheses to get 38%. So in this case, 38% again tells us that we are able to earn basically a 28% premium on our invested capital, because our cost of capital in this point is 10%. We're earning 38%, so we're actually earning a 28% premium above and beyond our cost of capital, and should certainly enhance the clinic's financial condition. So what does it mean when the internal rate of return is 0%? Don't get confused. This is not the same as it's not our break-even point. Okay, our break-even point in terms of IRR is actually 10%, or what is equal to our cost of capital. Okay, so an IRR of 0 is actually telling us that we are losing 10% on the transaction if it were to come out that way. Okay, so with that in mind, realize that everything that we have in that spreadsheet, as this cartoon kind of implies, is based on our own projections, based on our research that we've been able to do, and however well-intentioned, we have to realize that we might get something wrong. Okay, we might not know everything that we think we want to know about a particular project, about a particular investment, an initiative, whatever the case may be. So with that in mind, we want to be able to what if our projects a little bit, to say, okay, well, what if our volumes aren't what we thought they were going to be, or what if our costs are higher than what we considered, and kind of walk and talk through that process in some detail. So with this in mind, introducing basically 3 different risk assessment techniques, and I'll be the first to tell you I use 2 of them pretty extensively, the sensitivity analysis being one, and the Monte Carlo analysis being the more robust sort of process. I generally do not use the scenario analysis, and I'll explain why I don't for my own practical purposes here in a second. Okay, we have to understand, even when we what if something, though, from a project standpoint, it's going to have, it's only as good as the data that we put into it. So we're still far from precise, but at least we can start to answer the question to any sort of organizational decision maker about how viable and basically what would happen if, or what are the chances of, that sort of discussion. Okay, so with this in mind, we're going to end up in all cases, as we start to evaluate basically the different outcomes for a particular project, our job is to highlight and understand what the risk factors are, and either from a managerial standpoint say, okay, well, it looks like our volumes might be at risk here, so we want to be really careful about how we manage marketing, what sort of outreach we have, and on the healthcare side, what are relationships with a physician, for this particular service line. And if we find risk factors are higher than what we thought, and this goes back to our second section, then we can apply a different discount rate to appropriately adjust for that risk. Okay, so different types of project risks that we're going to see: individual project standalone risk, individual business standalone risk, or the market risk. Okay, and with the standalone risk, again, this goes back to our second section. If we're understanding that a standalone risk factor is different or higher than our typical, or as it compares to other projects, this is where our work with regards to standard deviation, or by extension, which we didn't really talk about, coefficient of variation. I invite you to look that up. As we start to talk about that individual standalone risk, that might actually influence us more than anything else. And of course, if we have, and going back a couple slides here, if we have corporate risk, if we're perceiving that our organization or our industry, and this lends more into the market risk, industry might be moving into more shaky territory from a policy standpoint, from a legal standpoint, from basically just tastes and preferences standpoint. Those corporate and market risks need to be recognized and need to be built into basically the project that we're actually discussing at any particular time. Okay, and we have to be honest about it. And where we see organizations go wrong is they kind of bury their head in the sand with regards to risk, don't really consider all those risk factors, and suddenly are pursuing projects they probably shouldn't because they haven't adjusted appropriately. It's hard to do, admittedly. So if we go back to that prior example, that basically buying that same piece of diagnostic equipment we just talked about, all the same calculations, okay. We can now start to, if we build our model right, we can start to do some of these what-if analyses, okay, where we can basically take our baseline starting rate, our net present value, and start to make adjustments, right? That starting net present value is essentially our base case, okay? And now what we can do is start to make single point adjustments using sensitivity analysis. So what does that look like? Well, all we'll do is we'll take a single point. In this case, we're going to look at utilization or volume and labor costs in this project, and we're going to vary those input variables by upwards and downwards 10, 20, and 30%. So I'll take my starting base, right? That was our original net present value. Now I'll hold everything over here on the right hand side constant, okay? And I'll take my utilization, my volume, and I'll reduce my volume number by 10%. And I'll record the new net present value. Or then I'll next, again, holding everything else constant, reduce my volume by 20%, record my new net present value. And essentially in this process, through basically just manual manipulation of my model, I can get an understanding of kind of the range of net present values by varying some of my key input variables by upwards and downwards 10, 20, 30%. So to do labor, of course, then I return my utilization number back to baseline. Okay, so that's back to, in this case, our input was $5,000 or 5,000 scans per year. Okay, I'll return that to 0, and then I'll go over to the labor side and I'll say, okay, well, what if I have to pay 10% higher labor costs? Which again, remember our labor costs over here were 100,000. What if I have to pay 10% more than that? Okay, so on and so forth until I develop this chart. Then I can graph it, and this is where the visual representation really can do us a lot of good, because the steeper line, okay, on this graph tells you that that particular input variable is more sensitive, or our net present value rather is more sensitive to that particular input variable. Okay, so the steeper lines, and we might recognize these are just two of the variables. In any given project we may have 10, 15 input variables that we want to diagnose. Okay, anything that provides a really steep slope basically tells us that that particular variable is something that we need to keep our eyes on, or we need to adjust our marketing, we need to adjust our contracting, we need to adjust something to help us to mitigate or to manage that risk appropriately. Okay, so steeper lines show greater risk, because and really the difference that we're trying to make at this point is not only just to draw a pretty graph, right? It's really to help us to understand where those risk factors are and how we can adjust our, basically our management and basically oversight of a particular resource utilization or particular aspect of the project. Okay, so in this case, utilization is steeper. In this case, we want to start to be talking about marketing. We want to start to be talking about who or what influences that utilization, and of course adjust appropriately. So some advantages to this: obviously it's fairly simple to do. It does provide us some understanding of what's going to break even and how it's going to break even. Disadvantages, of course, is we can only vary one individual variable at a time. It provides really no quantifiable measure of risk other than basically what we've been able to identify in virtue of a standalone or standard deviation sort of risk profile. Okay. Second one that I mentioned is scenario analysis. What scenario analysis does, it's going to look a lot like what we covered in the second section of the course with regards to that distribution, but it gives us a range of possible outcomes that can, although it can provide us a quantifiable measure of risk, you'll understand in short order why I tend to gravitate away from it, but I at least want to let you know what it looks like. So in this case, we've got a probability distribution, not unlike again what you saw during the risk and return section of the course. We have a worst, a most likely, and a best case scenario. Again, this looks like a bell curve, and then we've thrown in numbers that are likely if we have a worst case scenario in terms of utilization, in terms of fixed costs, this being our labor costs, for example, and then what we might see in terms of a net present value at that particular outcome. Same way on the best case side, and doing some of the calculations that we've done in the past, we can do our expected net present value, the standard deviation on the net present value, and a coefficient of variation on that net present value, or the amount of risk we're incurring for every dollar of expected net present value return. This becomes valuable when we have multiple projects and we can start to understand basically how one compares to the other with regards to the coefficient of variation. Okay, so suppose my average project has a coefficient of variation between 0.3 and 0.6. That coefficient of variation now is 0.74, so that's basically higher than the average bear. This, of course, is another reason why we would want to adjust our discount rate appropriately, or we might want to consider a different project if our risk tolerance isn't what it needs to be in order to move forward with this particular project. So there are some advantages to scenario analysis, and I don't want to discount them in the sense that it can provide a quantifiable measure of standalone risk. The disadvantages, I think, though, in my humble opinion, especially when we start talking about the next methodology, is it basically forces all extremes to happen at the same time, which of course departs from reality in most cases, and really, all models, basically it a little bit of the kind of presumptive outcome with regards to any sort of your input factors involved and what the outcome might be. So I tend not to use scenario analysis. What I tend to gravitate towards, if not single point with sensitivity, I tend to look through the Monte Carlo lens, because unlike scenario analysis, I can now, through a Monte Carlo lens, let each one of the potential outcomes vary, and you'll see what I mean and what that actually can produce here in just a second. But essentially what the Monte Carlo does is provides us a probability distribution for basically our net present value outcome. Okay, so with this in mind, I can let this process iterate, and I can share a model that basically allows this to happen 10,000 times. We could build it more if we want, but 10,000 I found provides a pretty good understanding of the potential variation, and essentially gives us this distribution. And in this particular case, you can see where the cut line is 0. I've got an 82.1% chance that this particular project is going to be profitable. In fact, I can provide a 95% confidence interval of what the net present value is going to be. And then this is just from a pretty standpoint. This is the total distribution, and this is my cumulative probability as I go from left to right on the chart. Now, I will argue few will do this. Okay, And if you want to see more detail on this, we might have to set up a Canvas conferencing session so we can actually walk and talk through how this is done. But it's all based on our initial starting capital budgeting framework that basically helps us to see when all the cash flows are going to occur, and then we start to vary each one of the years as we go out in time by a slightly larger rate, because as we move through time, of course, from where we are right now, that potential variation becomes larger. But I think it provides us a much clearer picture in terms of, from a statistical standpoint, where this outcome is going to happen, or where this net present value is going to land. And it also allows variation from year to year, to understand that sometimes we're going to get things wrong, and we need to be able to absorb that variation from year to year. Okay, so some advantages of this, again, all those that I just covered, and some of the disadvantages, of course. While it might look very precise, it's only as valid as the input values that we put into the original capital budgeting structure. So we're always in threat of being, subject to the GIGO principle, or the garbage in, garbage out sort of problem. But ultimately, what we want to be able to do is say, okay, if this project is truly riskier, then we need to be able to adjust for it appropriately, either directly, as I mentioned before, or through adjustment of the project cost of capital. So in doing so, we adjust for slightly higher risk. We still have a positive net present value. So at least we can say at that point to any decision maker that's asking the question, we did adjust for this risk factor or that risk factor, or we've built in a new plan for marketing and it's going to cost X, and that of course is built into the project as well. All of that we need to be able to factor in. What I suggest is it's just not good enough to identify the risk. We have to tell our leadership, or we have to take action to adjust appropriately. So with this in mind, we also have the potential to encounter projects where we have entirely cash outflows. It happens more often than what you might think. In this case, we're considering two medical waste disposal systems, one requiring more workers and one requiring more capital or upfront investment. And you're likely to encounter this in your own industry, in your own time, in terms of various projects internally. Like if you're a servicing project team for somebody else, your waste vendors, anything that basically is not going to generate any capital for you. It's just you have to do this for either a logistical reason or practical reason, and therefore we have to be able to fairly evaluate what these projects look like. Okay, so in both cases, in this particular scenario, they're both 3-year life sort of scenarios or systems. There's no impact on this particular organization's revenues, so it's all based on relative cost, and we'll stick with the same cost of capital and average risk that we've encountered before. So this is how we'd set it up. Slightly different look. Of course, you can see there is a timeline involved. It's just going from top to bottom versus from left to right. And in this case, we have Plan W with, of course, this was labor. Plan C was more capital intensive up front, and true to its word, it's costing us $1 million up front with a $300,000 annual cost. So as we do the net present value for both of these, you end up with a slightly different net present value. In the case of W, it's 1743 in the negative, and in the case of the C, it's 1746 in the negative. The system we would choose, of course, is the one that is least negative or closest to zero. So in this case, it would be the 1743 option. Okay. Now, suppose that Plan W is judged to be riskier than Plan C because future wage rates are difficult to forecast. With that, if we do our normal risk adjustment, okay, and we always adjust for risk in a normal basis by adjusting our discount rate up, right? So as we get our weighted average cost of capital, if we adjust for risk, we always increase that discount rate, and by doing so, normally it lowers the valuation of all of our future cash flows on a present value basis. If we do that in this case, if we put 3% on top of our 10% weighted average cost of capital, we end up with a new net present value on W that is better looking than what it was before. It's now closer to 0 than what it was before. In this case, even after adjusting for risk, we'd say, well, okay, if we did this normal adjustment, we'd still choose Plan W. Now, inherently, that should not make sense to you, right? The riskier option should move in the other direction because our valuation process, our risk adjustment process, says that it's a riskier option, so it shouldn't move in a more positive direction. So with this in mind, and this is something just to file away for the purposes of this class and in the future, whenever you have a pure outflow project, a project that is nothing but negative in terms of cash flows, and you have to adjust for risk, you need to move your risk discounting process in the other direction. In this case, we reduce our discount rate by 3%, which gives us a more logical outcome with respect to what that W project actually is on a net present value basis. Okay? After we adjust for risk using 7%, redo our net present value, we understand that now we've got a dollar value that's further away from 0, and as a result is probably not the project that we want to pursue in consideration of what Project C is doing. Okay? So with that, ladies and gentlemen, that concludes the project risk analysis and capital budgeting section of the course. By all means, again, this is probably one of the most important areas of the course to consider, and certainly should be part of what you should truly walk away from this particular class with and knowing fairly well. So if you have any questions, you have any concerns, by all means reach out. And with that in mind, I've also included an example at the back of this, specifically that includes an example with taxes and depreciation that we did not include in the sheet, and I will cover that in a section or in a different video, so we can put this one to bed and let you go about your day, and I'll record that here in just a second. So thanks for your attention, and we'll talk to you soon.